So, Danny, we've seen geopolitical tensions escalate into a full blown out war between Russia and Ukraine. And this has obviously had an impact on trade as well as international oil prices. Do you care to take us maybe through some of the impacts that this has had on some of our key economies?
I guess the main one that everyone has been discussing over the past few months has really been Egypt. And so Egypt, from the perspective of having quite a reliance on wheat products coming in from Europe, specifically Russia, Ukraine, and that having an impact on inflation, has pretty much taken center stage. What other people may have also forgot is that we've also had other economies that are quite dependent on wheat, such as Kenya. And this is then played out with having this environment where there's a full-blown war, like you mentioned, taking place. And these key markets having to navigate an environment where general price levels are going up. On the Egyptian side, we've already seen inflation tick up quite high. Kenya, we still have an expectation that it might breach higher than the target range over the next few months. So this is a key point of discussion, really, just having this war and how it is adding on to broader supply chain disruptions that are already taking place and how that had already created an environment where in 2022 into 2023, we're expecting elevated prices. And now, because of oil prices teetering higher than over 100, because of what we're seeing taking place with respect to food, a broad expectation now that food prices have gone up. The long and short of it is inflation seems like it's here to stay for even longer, with some markets bearing the brunt of this versus others.
So the Russia war has obviously created more upside, or rather downside risk to our outlook.
Yeah.
And, most of our economies still need to chart away from out of the disruption caused by the pandemic. In terms of what the IMF is offering and the support they offer some of our key economies, do you care to highlight some of the support?
Yeah. So that's a very valid point. We're entering this high inflationary environment, and it's actually starting to negate from growth. And I think this is a point not enough people are talking about. We're in an environment where businesses are having to face 10 to 15% increase in input costs on top of what they were already facing a year ago. Subsequent to that, we've also seen an environment, like you rightly stated, coming out of this pandemic where the IMF has been able to support some of our key markets. And I think one that everyone has really been discussing is Zambia, as they wait for their board level approval. Likely the expectation, at least from the authorities, by the first half of the year. We think that this might, likely be delayed, maybe into the third quarter, but that's somewhat irrespective. The idea is that there is some fiscal stimulus that is needed. What we also found quite interesting was for an environment like Egypt, where they've also started having discussions with the authorities of some form of support with respect to just the challenges that they're facing because of the Russia-Ukraine war. Could there be more countries that are going to need additional support? Yes. And this is likely. I mean, Kenya is already under an IMF program. At this moment, this we're well aware of. I guess there's been some form of international discourse and discussion around an environment like Ghana. Potentially, could they get into an IMF program, given some of the other broader fiscal challenges that they've had? But I think the long and short of it is that we're in a period where there's definitely support from multilaterals, from other commercial lenders, from debtors, to support both the fiscal journey that countries are going through, and then now, even more importantly, having some discussion about how do these countries generally recover in an organic manner over the next few years, given just this high inflationary costs.
All right, so you mentioned Ghana and charting a sustainable fiscal path. So do you care to share some of the highlights that came out of the fiscus that stood out to you?
So they had this budget that they presented towards the end of last year, which, it came out to the market as if it was less than palpable. We saw there was general issues around credibility as to whether or not they'll be able to meet their tax revenue targets. And I really believe at the time there was also concern around expenditure. What effectively has happened this year is that they've had to make some very difficult decisions. One of the taxes that they proposed was this e-levy tax, and that has been in the media for quite some time, has now effectively been passed. The idea was that it would generate up to 7 billion worth of Ghanaian cedi, 6.9 give or take. It no longer seemed to be on a path of fiscal sustainability. But what we've seen in terms of an update of this tax, that suddenly we're looking at a very different, Ghanaian environment that has been able to stick to its laurel increased tax revenue, or at least the expectations that they will be able to meet their tax revenue estimates. And at the same time, the government has made serious concessions from the perspective of expenditure. And it raises a broader question that even in this period where several countries are having to contend with some of these other external factors, is there a greater demand for fiscal prudence? And this brings us to a bigger theme we raised earlier this year, with a lot of that fiscal impetus and injections that different countries had introduced. A lot of that might actually start unwinding, and we'll enter an environment where fiscally things might get a bit tighter for these markets, despite all these other challenges that they're facing.
So you mentioned quite a lot of challenges, opportunities as well. But what does this all mean for monetary policy as well as liquidity across the continent?
This is probably an area where, from an economic point of view, we always said that it would be unavoidable post the pandemic. We'll be entering a higher interest rate environment. I think the narrative there was really around normalizing interest rates. What we're talking about now is normalizing interest rates, but then also arresting inflation. This means that a lot of our markets have had to institute already, or they'll likely be instituting anywhere between 200 to 250 basis points worth of hikes, either from the beginning of this year up until the end of next year, amid an environment where inflation is likely still going to remain upwardly sticky because of higher food prices and other higher oil prices like we've discussed. And then, of course, the supply chain disruptions continue to be quite pervasive. So high interest rate environments. But then also, unfortunately, when you start looking at issues around liquidity, it hasn't fully recovered. We're still seeing some markets where, the local currency is weakening quite aggressively against the dollar. We've seen that happening in places like Kenya and also Ghana. And at least on the latter, we've seen central bank intervene a little bit more. On Kenya, that hasn't happened to the extent that it has happened previously. But what we're trying to say is that the liquidity challenges will likely still be there during the course of this year, until we get into an environment that's somewhat a little bit more stable. And I think for us, that will probably be well after the war, probably entering periods like 2023, where we can really start seeing any form of currency stability.